14 of 21 series are aligned with acceleration mild this morning. That is a mid-range, moderately coherent configuration across the framework. The current macro regime is acceleration mild, with a confirmation score of 14 out of 21. In this macro regime, the math is observing growth momentum accelerating at plus 0.03 and inflation momentum accelerating at plus 0.01. Both composites measured as positive rates of change relative to their recent baselines. The coherence score is moderate, and the confirmation score of 14 out of 21 series sits in the middle of the framework's alignment spectrum. Historically, similar alignment levels have persisted in roughly 47% of observed cases over rolling 3-month windows when reached from comparable starting points, a description of past frequencies, not a roadmap. Compared to recent weeks when alignment was lower, confirmation has moved up into this moderate band, while inflation's rate of change has edged higher but remains far from the framework's high acceleration zone. In past environments with simultaneous growth and inflation acceleration, markets often felt like they were managing a tug-of-war between stronger nominal activity and rising price pressures, a record of behavior in the data, not a message about what anyone should do today. Let's walk through 4 signals the engine is watching more closely under this backdrop. First, Treasury yields. The 10-year note sits around 4.68%, with the curve modestly positive versus the 2-year at 4.23% and the 30-year near 5.21%. The engine currently flags long-term yields as red momentum, defined here as yields moving higher and holding above recent ranges in its rate of change layer. Higher yields matter because they reset the discount rate across equities, credit, and real assets. In our framework's reading of comparable periods, this roughly coincided with pressure on long-duration assets and mixed behavior in cyclical sectors within a 1 to 3 month time frame, an observation under our methodology, not a forecast. The practical question institutional readers tend to ask is whether this yield configuration matches how risk is priced across their book, and what would challenge the read is a decisive retreat in long yields back toward prior bands. Second, labor conditions. While there is no major new employment report in the last 24 hours, the engine's labor composite, anchored in non-farm payrolls, the unemployment rate, and job openings, remains in a neutral to slightly firm posture. The momentum label here is yellow, defined mathematically as a flat to modest positive rate of change that does not yet qualify as clear acceleration or clear deterioration. Labor data matters because it shapes how participants think about growth resilience and central bank reaction functions. In our framework's reading of comparable periods, this roughly coincided with cross-asset pricing that was particularly sensitive to surprise labor releases over the following month. A record of past behavior, not a forecast. What would challenge this interpretation is either a sharp weakening in hiring or a renewed tightening in job markets that pushes the composite into clear acceleration. Third, credit spreads. High-yield corporate bond spreads, as captured in the framework's credit composite, are tagged red this morning, defined as spreads widening relative to recent lows and pushing the rate of change layer into a negative reading for credit conditions. Markets watch credit because it often serves as a stress thermometer for corporate balance sheets and future default risk. In our framework's reading of comparable periods, this roughly coincided with more cautious cross-asset behavior and underperformance in lower quality credit over 1 to 3 month windows. Again, an observation in the historical data, not a forecast. What would challenge this read is a sustained tightening in spreads that pulls the composite back toward green. Fourth, equity sectors and commodities. Technology and healthcare are modestly softer, while industrials and energy show relative strength and oil prices have dropped sharply, even as gold is firmer in futures. The engine tags this cross-asset mix as yellow momentum for cyclical sectors and green for select real assets, defined as sector and commodity performance diverging, with some areas showing positive rate of change and others negative. Participants track this because sector rotations and commodity swings often reveal how markets are digesting the regime's combination of growth and inflation signals. In our framework's reading of comparable periods, this roughly coincided with ongoing leadership shifts across sectors over subsequent weeks. A record of rotation, not a forecast. What would challenge that pattern is a broad, synchronized move across sectors that flattens the dispersion the math is currently recording. On the conditional map, two specific triggers stand out. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation composites showed acceleration in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. Under an acceleration. Mild regime. Such a move has historically marked periods when rate markets leaned harder into the inflation side of the narrative. Second, if the fear and greed sentiment gauge drops below 15 and holds for 5 consecutive sessions, in our framework's reading, the regime confirmation score deteriorated in roughly 7 of 9 similar conditions. Again, a historical characterization, not a forecast. In this regime, that has tended to align with sentiment, overruling some of the underlying growth and inflation math. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. All of this is framed as potential, educational, a structured way to look at the data, not to tell anyone what to do. The morning brief is the public surface. The live observation desk shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the engine's outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members.